Okay, the next team is Kratos, K-R-A-T-O-S, Kratos.
As yields in key gateway markets continue to contract and capital cannot find adequate returns, investors are growing hungry. Acquisition teams across the United States are asking themselves two questions. First, is it time to find yield in secondary markets? And second, can we get a return of that capital before the next recession? My name is Jack Henry Kapp.
I am Tia Wei.
I'm Jackson Fu.
I'm Sarah Murdoch.
I'm Ryan Hukowski.
And I'm Yiwei Chen.
Last week, we were presented with a potential portfolio acquisition by Covenant Capital. Its fund owners, Lawrence and Samuel, had 30 properties, which 2 years ago, they decided to liquidate down to 12 properties. Now, they only have 3 properties in the portfolio. Unfortunately, Samuel has fallen ill, and there's a need to liquidate the entire portfolio by the year end. Of these 3 properties, we have developed a strategy for each of them if we so choose to include them within our portfolio. In Charlotte, our strategy would be to gross up the building to market rents by adding in new quality amenities as well as offering tenant signage within a 3-year hold period. In Oklahoma City, we would reconfigure the retail space, which would create office synergies, also within a 3-year hold period. And third, in El Segundo, California, our strategy would be to flip the property to the anchor tenant who has a key incentive in buying the deal within a 1-year all-cash equity deal. In total, if we choose to execute on these 3 strategies, we will have a $46 million equity contribution.
Queen City Tower is a 500,000 square foot Class B+ office building. It is located in the heart of Charlotte's CBD, in close proximity to the convention center and 3 sports arenas. However, despite its great location, Queen City Tower is not able to compete with the superior Class A supply in the market. Currently, it is underperforming even Class B market averages. If we invest in this property, we are proposing a value-add strategy. This would include redeveloping 1 floor to be an amenities floor, as well as adding to occupancy by relocating the below-rent Charlotte Tech tenant to a lower floor to accommodate for the law firms who are willing to take this space at market rents. We underwrote our lease assumptions very conservatively at Class B market rent levels, despite the fact that we are a B+ property and we will be adding significantly to this asset quality. To compete with the superior Class A supply, we are proposing adding Class A quality amenities to 1 floor, including dining space, shared conference space, a fitness center, as well as allowing our 2 largest tenants a building signage opportunity, which would incentivize them to renew their leases. The Charlotte market is a major financial hub and therefore was hit particularly hard during the recession. However, Charlotte has shown recovery, including that it has had the 2nd largest post-recession population growth in the country. Additionally, unemployment rates are back to pre-recession levels. The Charlotte employment demographics are becoming increasingly diverse, showing that Charlotte is more than just a finance hub. Class A is significantly outperforming Class B, both in terms of market rent growth and absorption, demonstrating that there is a demand for higher quality product within the market.
We can mitigate the high rollover risk for the 2 major tenants by providing them with building signage rights. We're also pricing our rents at a discount to Class A level rates, even though we have competitive amenities. Charlotte is the 2nd fastest growing market in the United States, which means that there will be an increased supply coming online in the next few years. However, we have found that projections also show that there will be an increased supply absorption for the same exact reason. Again, the lower rents help us to remain competitive within this market, even though there is an increased supply. Charlotte experiences very volatile changes due to its boom or bust environment. However, we're also seeing a diversification away from a sole financial services sector focus and into other sectors as well, including technology and healthcare. We are confident that our position in the CBD area will allow us to receive any limited demand in a bust environment.
We underwrote this property very conservatively. The $55 million asking price is equivalent to $106 per square foot. We already received a term sheet from Bank of America for interest-only loan for this property. We plan to hold this property for 3 years and sell at a higher than market cap for $66 million, which is $130 per square foot. Our overall return on this property is 12% unlevered IRR and 1.4 equity multiple.
Durant Center is a 350,000 square feet office and retail complex located just south of Penn Place Mall, a Simon property with over 1 million square feet of upscale branded credit quality tenants. Our retail across the street is suffering as a result of the fact that it's mostly mom and pop shops of an older vintage. And so the 150,000 square feet of retail is only 51% occupied. Our office product is much more consistent with the market at 87% occupancy. However, we do face some lease roll risk moving forward. We recommend repartitioning and repositioning the retail space in order to appeal to a national gym chain like LA Fitness. Again, our retail simply can't compete with the product that's across the street as is, and as a result, we need to do something different in order to create strategic value in this asset. Within a 3-mile radius of the property, there is 93,000 current residents earning an income of $50,000 to $60,000 per year. There's only 3 fitness facilities within the 3-mile radius of the property, which simply cannot service the demand of this market. As I mentioned, they have above average incomes and also are of a younger age than the national population at 36 years old, which we believe would incentivize a younger, more profitable individual to want to purchase gym memberships. Additionally, health insurance companies are increasingly subsidizing gym memberships, and as a result, we believe that we can have more and more people being able to be members of the LA Fitness community. The Oklahoma City market also speaks very well to its increasing and improving fundamentals. Unemployment rates have fallen to below pre-recession levels, and are now, even though Oklahoma City has classically been an oil and energy-driven economy, it's actually diversified substantially to include a lot of different office tenants from various different sectors. Our rent per square foot is consistent with the market. However, our vacancy is slightly above market, which we recognize as an opportunity for improvement through this fitness office synergy.
We have separated the major risks for this building into 2 components, the office component and the retail component. The major risk coming to the office building is that there is an unknown percentage of leases rolling in an older building within a volatile secondary market that is largely dependent on oil. However, what we do know is that 2 of our major tenants have recently renewed their leases after a $2.2 million renovation project that was executed to improve the building's infrastructure and its facade. We also know that there's an increased diversification away from the oil-only market to include other sectors such as government services as well as healthcare services. For the retail component, our largest risk comes from securing and installing a fitness tenant into the space. Our 50-day due diligence period before we have to decide on whether or not we want to close allows us to approach several credit quality tenants, and we're also already in conversations with LA Fitness in order to execute a lease for this space. To avoid infrastructural risks, we are allocating a space that is not on the load-bearing part of the retail mall, and we're also allocating $100 per square foot capital expenditure in order to ensure that this fitness center will fit into our building's infrastructure. We are not expecting any risks coming from either the deed side or the zoning regulation side, and in order to manage the uncertainty around the renovation schedule, we are intending to include a 4-month contingency within our renovation plan.
In an effort to remain conservative, the $50 million asking price is equivalent to $42 per square foot. We have another interest-only loan on this property, and we plan to hold this property for 3 years and to sell at a higher than market cap for $22 million, which is $62 per square foot. Our overall return on this property is 14% unlevered IRR and 1.4 equity multiple.
The El Segundo Plaza is a 185,000 square feet Class B strip center that was built in 1960. There are currently 2 major tenants in this particular asset. As you can see, you have Martha's, which is a neighborhood furniture store and takes up about 40% of the square footage of the building. And another major tenant is La La Land, which is an adult entertainment venue operated by and owned by a public traded company.
and that is 43% of the square footage in this asset. Because we have this really unconventional tenant in this building, it has been challenging for this asset to be sold in the last 2 years. And also, the lease when it expired in 2015, there is this possibility that 43% of their square footage will expire. So our strategy here is really to buy this asset today and flip it back to La La Land. And if La La Land chooses not to pursue this deal with us, we will not renew their leases. However, La La Land is a willing and able buyer. It actually owns the real estate of the majority of its portfolios and also has a really healthy balance sheet with $25 million in cash at its disposal. And it's also motivated because due to the zoning restrictions in Los Angeles County, it's really challenging and time-consuming to get the same business permit that will allow you to operate an adult entertainment venue. And to further sweeten the deal for La La Land, we have underwritten an $85 per square foot sales price for them. And as you can see, $85 per square foot is actually on the lower end of where the comparable properties have been trading at in this particular area. The $30 million asking price is equivalent to $72 per square foot. We plan to purchase this property with all equity since we are flipping the asset in 1 year and sell at $75 per square foot, which has an implied cap rate of 7.6%, and our overall return on this property is 28% and 1.2 equity multiple.
Because our strategy is reliant on La La Land accepting our offer, our major risk really lies in the possibility that they might reject our offer. As such, in this event, we will refuse to renew their leases, and we'll also begin the process to convert the entire space into a warehouse facility, which is more consistent with the site users around in the surrounding spaces. We're also confident that we'll be more easily able to obtain financing for a property such as a warehouse facility, more so than a strip center with La La Land as an anchor tenant. We're also confident that there will be a larger pool of buyers for this property from institutional investors such as REITs at our exit.
The MC Capital Funds have a value add and opportunistic investment strategy. It usually have a very short-term holding period, and it seeks to have IRRs in excess of 20%. It is also willing to take higher risk for higher returns deals with their typical equity commitment. The $800 million Fund 3 has deployed 30% of its capital. As you can see, its investment has been very diverse in terms of market and geographic distribution. Since the fund has been performing very well, we further underwrote these 3 opportunities to make the returns consistent with the property that are already owned in the fund, who are comparable office mixed-use developments with very similar business strategies. Since we are undertaking a lot of risk and with higher IRR benchmarks, the maximum bidding price we are willing to put on these 3 properties are 11%, 13%, and 5% discount of the asking prices, which is a total of $46 million equity commitment upon acquisition, and our overall portfolio return is 30%.
In its current form, the partnership structure does not fit within our fund. Marco, who has a 10% equity investment, is requiring that all decisions regarding refinancings and sale of the individual assets would require unanimous approval, which does not fit within our structure. At the same time, our fund has realized that Marco presents a key strategic conflict of interest. In this deal, he would be acting as the buyer, the seller, the future asset manager, and the future property manager. We are not comfortable with that assertion, and therefore we offer the following alternative. If we pass on Marco as our operating partner, which he has offered to be, we would use a 2-pronged approach. 1, we would deploy our internal asset management team to manage the properties from our offices. 2nd, we would hire a national property management firm to work on a local level with each individual specific property. We believe that this is a good alternative to working with Marco. When looking at the 3 properties, there are key and inherent risks that are associated with each of them. At the same time, we do feel that under a conservative underwriting analysis, there are opportunities that do exist. However, there is additional information that we would need to make our final decision. This information could ultimately influence the way we decide to go forward with the deal. We would need specific tenant information as well as other specific financial information in order to proceed. With the information presented today, we can provide the following bid estimates on a conservative underwriting basis. Thank you very much for listening to our presentation. We'd like to open it up for the judges for questions.
Hi. You guys did a great job. Very well put together, and it was a great presentation. So one of the things you said about the, about Marco is that you wanted to kick him out and you ultimately do the deal yourself. What specifically bothers you about the fact that he is, the property manager previously, will be the property manager in the future? Also, what is the issue with him, being the buyer and seller?
Yeah, so just on a more macro level, our team analyzed the cost-benefit analysis of bringing him into the deal. Traditionally, as a fund, that's not something we're necessarily comfortable with. And so when looking at Marco specifically, what we said was we feel that the advantages that he brings as already asset managing these properties really don't outweigh the conflict of interest that he presents, acting in 4 different capacities. At the same time, Tia can talk about if it was contingent on bringing Marco into the deal, what the current partnership structure would look like, as well as a modified partnership structure. So what we felt was that under these 3 scenarios, which Tia can follow up on, it was ultimately best to not work with Marco.
So in any circumstances, we have to work with Marco. This is our modified promote structure. So there are 2 reasons behind this modified structure. First of all, it's to really put an incentive for him to help us sell the property as soon as possible. And the second is to change the major decision controlship of Marco. So we as a fund will have the major decision controlship of all the selling or financing decisions.
At the same time, this is more also about the dynamics at play. If we have an individual who's coming at us with a deal who's saying with only a 10% equity investment, he would like to have unanimous decision approval, that's not something as the individual partners that we're working with that we feel comfortable with that dynamic.
Go a little bit into the strategy of converting also into warehouse space. Specifically, do you have information on vacancy rates?
Sure. So for the, to convert El Segundo Plaza into warehouse, currently we are aware that the furniture store is paying below market rent, and they also have 7 years to get for their lease to expire. So our strategy is to buy them out with at a maximum of $1.5 million, and we will gradually convert the entire space into warehouses. The reason why that a warehouse would make sense in this case is because, as you can see, for El Segundo, it's at the intersection of 2 major highways and 2 railroads that connect the West Coast to the East Coast. And it's also in proximity to Los Angeles International Airport and very close by to the Port of Los Angeles and Long Beach. And that is the timeline that we're gonna do the conversion to convert the entire space into warehouse. We'll start with La La Land, the 84,000 square feet, and then when we buy out the Martha's neighborhood furniture store, we'll start a conversion on that part. And currently, the South Bay area where El Segundo is performing better in terms of industrial and warehouse leasing activities. And the triple net rent is about 10.1 per square feet, which is much higher than what Martha's has been paying for their leases, which is at $6. And that is to show that the South Bay submarket actually is trading at a much favorable price as compared to the general South California market. And we are confident that we can find major REITs in the US that will be interested in this particular market.
What's your backup plan if the LA Fitness thing doesn't work out and you can't get a fitness center in there? What are alternatives?
So in order for this strategy to actually work, we would need to have a large big box style tenant. We're not just going to build and not have a signed LOI in place or a signed lease. We definitely need someone to be there ready to pay the market rents in order for us to go ahead and proceed. This is a huge capital expenditure, and it's just something that we wouldn't be comfortable doing without knowing that there was something in place. We could alternatively look to different types of fitness chains, 24-hour fitness. We could also do another big box retail tenant, like a TJ Maxx or another discount-oriented retailer, which the market doesn't necessarily have as much of.
Our goal would be to have a signed LOI during the due diligence period prior to closing.
I just want to clarify something on the warehouse space that you're thinking of converting. For real warehouse space, you need loading docks and, 36-foot high or whatever. Are you planning to do the renovations for that, or are you talking about self-storage?
We're talking about bulk warehouses, and the specific of conversion is that we estimate that the ground-up development for warehouses in South California is about $40 per square feet, and for this case, we already have the shells of the building, so it's more a matter of partitioning them into smaller spaces, and that we have underwritten about $30 in capex to convert this space into warehouses, and that will include loading docks and the other specific shelves that will be required for warehouses.
So kind of semi-warehouse office space for smaller tenants.
Yes, we'll dedicate about 10% of square footage to office, but the majority of it will be warehouses.
And it's important to note, too, that the La La Land space that we do have is a 2-story space. So we do have very high ceilings, which do make it favorable for warehouse.
Very good point. Thank you.
On the Durant Center retail repositioning, what kind of budget do you have to do what you're planning to do? Because you have existing tenants there that presumably probably have to be bought out, and they have tendencies that go probably even maybe behind your sell period.
Yeah, so presumably we don't know the exact rent roll within the building. We're imagining that half of the vacancy is not just allocated to the load-bearing side where we'd like to relocate them all to. However, we do understand that most retail leases actually have provisions where you can move the tenant under a specific set of circumstances. We may need to pay in some cases, and that's some details that, of course, we'd need to know a little bit more information about the leases in order to proceed. But also, we're confident in the fact that allocating half of the building wouldn't cost that much just because we have the existing building envelope in place, and effectively we're taking $100 per square foot of CapEx and renovating the exterior and internal building systems to accommodate the fitness tenant.
I have a question. You guys did a great job of outlining the kind of risks and your strategy, but you've changed the price, you've changed the promote structure. There's a lot of contingencies of getting the fitness center, et cetera. Are we recommending that we do this deal, or is it worth spending more time? It seems like there's just a lot of stuff that has to get together. And is there a few of these things that you would pass on, and are you comfortable proceeding with a deal if you don't get it done?
Yeah, so I think one of the biggest aspects of this deal is just because we don't have a majority of the information that we would need to know to proceed. We do recommend buying, but it's for the discounted prices that we've proposed, just because we're not comfortable taking any more risk than the other properties that are in our fund in better markets that are better quality. So in order to get the returns that we're looking for on a risk-adjusted basis, we would need to be buying these properties at a discount.
And that really speaks to the point that we talked about right at the end, which was that there is additional information that could sway our decision either way. We could either ultimately decide that we don't want to pursue these investments at all, or we may be able to get more aggressive in our discounting rates if the deal so proves that it would be beneficial for the fund.
Thank you very much.
Thank you.
Oh, the clicker.